Can everybody hear me without the microphone? Okay. Nobody wants to sit up front? No? I didn't know it was that repulsive. Just want to introduce myself. My name is Greg Stehlik. I'm with Huntington Bank. I'm a business banking relationship manager, so I do commercial lending to small businesses in the Cleveland and the Cleveland and Lorain markets here for Huntington. I've been with banking for about 15 years, and for half that time I've been working with small businesses in the local market. I was born and raised in Cleveland, and I have a lot of passion for small businesses, startup businesses, entrepreneurs. So it's a real passion for me, so I'm excited to be here. When I talk to small businesses, a lot of our conversations revolve obviously around many things, but most of it is cash flow related. How do I grow my business? How do I support my business? What are the sources of capital that we can help them provide? And we usually have good, long, in-depth conversations about how can we help augment your working capital, and how you really currently using your working capital to the best of your abilities. So luckily for you guys, I brought our subject matter expert here, friend and colleague of mine, Tom Leenheer. So Tom is our team lead and regional manager, vice president of the Cleveland and Toledo market for business banking treasury management. He is our internal expert. He helps advise our colleagues how to have these conversations with our customers and really dive deep into working capital management. So I'll get off the podium for a second and introduce Tom here. So thank you.
Thanks, Greg. Good morning, everyone. Thanks for the opportunity to spend a little bit of time with you this morning. So Greg's introduction was great. I currently get to manage a team of 9 treasury management specialists. So our job is we support folks like Greg. We have about 30 business banking lenders, relationship managers that span from Ashtabula all the way to Toledo. And probably you could take a line of Brecksville and go north, and that's what we call the northern area. So I currently get to lead that. Prior to going into that role, I think it was maybe September, October of last year, I was the bank's only working capital sales consultant. So I actually trained our colleagues on how to have in-depth, as Greg said, working capital conversations with customers about doing things better, doing things differently, doing things more efficiently. I got to visit probably with about 80 to 90 companies last year, ranging from large corporate size, 400 million in sales, to companies around $1 million in sales. So had a lot of fun, a lot of unique experiences. I love small business. My father's a small business owner. I've been in banking, I think, about going on 16 years. Over 10 of it's been in small business. I just very much enjoy getting to meet owners, the family-like atmosphere, how they treat their employees. It's just a big passion of mine. So in banking, you try to find the value of what you do for a living, and in treasury management, at least here at Huntington, it's about trying to advise our customers how to do things better. If it happens to correspond with more things for the bank, hey, that's great, but that doesn't always work out that way. It's more about making our customers better, making our customers more profitable, which in essence will help us if we're helping them. So as we go through this presentation, we're really focused on getting better in managing working capital. So working capital means a lot of different things to a lot of different people. Some people think it's a source of cash, it's a line of credit, it's how I sustain my business. For this presentation, we're really going to focus on the management aspect of working capital. So working capital management. So it's everything you do that has to do with the cash of your business. So the official definitions there, I'll spare you that. What working capital is current assets minus current liabilities. Not so much focusing on the net working capital. That's just a formula I put in there for a comparison. We're focusing on the management of that capital. The how, the who, the what. How do I collect from my customers? How do I set terms with my customers? How do I pay my vendors? How do I manage my inventory? These are all things that has to do directly with your working capital. What we're trying to get to, everybody ideally wants to be best in class. It's a very cliche phrase right now. I want to be best in class, and we use it so much at the bank. I want to be best in class in my personal life if I could. It's not always possible, though. But what does best in class working capital management afford you? One, probably one of the biggest ones, it can reduce your interest expense. It ensures you're not borrowing too much. You're making the right borrowing decisions. It reduces risk. Checking fraud has never been at a higher level. Wire fraud. I mean, the fraud situations we run into weekly at the bank still continue to amaze me after 10 years. It can reduce your costs, whether that be a tangible cost, such as putting stamps on envelopes, printing checks and mailing them. Maybe it's an intangible cost. Maybe it's your free time as a business owner. One of the conundrums of the small business owner is you're used to doing it all yourself. As you start to grow, it can be a challenge because you might not be able to do it all yourself anymore. It was one thing when you only had 10 customers to take checks to the bank and get it taken care of. Oops, sorry. It's another thing when you have 1,000 customers, you're not going to be able to do that anymore. You might not be able to do it when you have 300 customers. So it's about trying to reduce cost. It's also trying to reduce errors in forecasting, errors in reconciling your accounts every month. Best-in-class working capital management can enhance your operational transparency. So collaboration, you start talking to each other a lot more. I've ran into a lot of situations where business owners, you have your office manager, you have your business owner, maybe you have an accountant, your relationship manager, your banker, and there's not a whole lot of conversation. And we like to encourage collaboration, talking, meetings, getting ideas from your employees. Process efficiency. If there isn't something that I hammer down more in this, it's about being more efficient, getting better. Efficiency means back to reducing costs. It also means reducing the time you need to spend at your business and improves your work-life balance, which is super important. Information reporting. Getting the information you need to make the business decisions that you have to make on a day-to-day basis, whether it is to reach out to the bank for a line of credit, whether it's using your credit cards to try to make vendor payments now, because credit cards let you sit on your own cash for an extra 30 days. Little concepts like that. And industry insight. You get so caught up in running your business, so caught up in managing your customers, that sometimes you can lose focus of what's going on with your competitors, what's going on around you. Best-in-class working capital management helps you stay in tune with that. So, also I should say, if you have any questions, feel free to stop me. This can be interactive. It's actually a little more fun when it gets interactive. I know we don't have a huge group, but if you do have questions, if you have challenges, you don't believe this to be the case, that even makes it more fun. So please, don't be shy. So, how do you measure working capital management? So it's all these best practices, there's some metrics, 2 different ways like I just mentioned. So you can take a look at key working capital metrics. So you can take your balance sheet, your income statement, crunch some numbers. If you have receivables, if you have payables, you can actually find out how long it takes on average for you to collect from your customers, pay your bills. You can also gauge yourself against best practices. How other companies strive to do it, or what's the best way to do it, and work out, see if you can actually get there. So those are 2 of the primary ways to gauge how you are doing with your working capital management. So let's spend a minute on the metrics part. Days payables outstanding. Okay, so I think that's the first one. So that's how efficient you are in collecting from your customers. So from the time you invoice a customer to the time that customer pays you, that is something you can measure, and it's called days payables outstanding. Something that someone like Greg would look at when he's determining whether you'd qualify for a line of credit. But more importantly, it's something you should look at and determine where you want to be. A lot of people just give the generic, we like 30 days. Maybe you offer discounts. Somebody pays you in 10 days, you give them 2%. Those are all things, there's a specific metric you can calculate that will help you determine that. Days sales outstanding, how long it takes for you to pay your inventory. In some cases, maybe not inventory, maybe it's your vendors. There's certainly service industries, I'm sure here, like accountants, law firms. You don't have AR. You don't necessarily have an AP. All right? That doesn't mean that these still can't apply. They just apply in a little different way. All right? It depends on your financial statements. Then obviously, days inventory outstanding, how long your inventory is sitting on your shelves before you're sending it out. Some of these concepts are remedial, but you'd be surprised how little these calculations are actually used. When I went out to these 80 companies, we had a lot of eye-opening moments. A lot of information you get from your accountant, you don't really use it. You don't know where to go, or maybe you don't have a basis to compare it to. Hey, our days payables outstanding is 30 days. What does that mean to you if you don't know where the rest of your industry is? It may not mean much. So when you're using these metrics to evaluate your business, it's important to note that there is not one end-all solution that makes it sound great. Certainly as a salesperson, I could portray as working capital metrics as the greatest thing since sliced bread, and you can easily push all those down with counterpoints, all right? So what's good about using metrics and gauging how well you're doing in managing your working capital? One, they're easy and they're fast. Most everybody does monthly balance sheets, accounting statements. QuickBooks can kick them out for you. You can reach out to your accountants. They're very easy to calculate. It's simple division, mathematics, not hard. You can put it into a spreadsheet. They're universally accepted. So days payables outstanding, days inventory outstanding, days sales outstanding are utilized by accountants across the entire country, and in fact, probably across the entire world. So when I say days sales outstanding to one account, it means the same thing to another. So they're universally accepted. You can compare to historical data. So a lot of times when you apply for a loan, when you're doing a renewal of your annual credit, you'll supply financials. The bank will run these metrics for you. So in our evaluation sheet, we'll have the last 3 years essentially of what you're, at that given time, usually it's year end, right? That's when you're giving financials. So at year end, what your days payables outstanding is, what your days sales outstanding is, what your days inventory is. But is year end the best time to gauge that? A lot of companies at year end, it's the slowest time. It's not a real accurate representation of when you're really busy. So at year end, your days sales outstanding maybe 10 days. You're able to collect from your customers in 10 days. And you don't really pay attention to it when you're busy because you don't have time. But all of a sudden, when you're busy, you don't see that it creeps out to 45, 50 days. That's where using these metrics and comparing them historically year over year can have some value to you. As I said, it sort of ties into that periodic basis point. Where they don't work. So we mentioned they measure only a specific point in time. So if you're just relying on your year-end numbers, I think of an HVAC company, or one of the big ones is asphalt. I've done a couple asphalt companies we took a look at in this regard. Well, guess what? In February, they're not doing a whole lot of asphalt jobs, right? It's not in Northeast Ohio. So their day sales outstanding is extremely low. But you get to July, and that's one of those cases where you see it really kick out. Working capital metrics do not take your segment into account. Similar to what we just said about the asphalt company, unless you're using benchmarking tools, you really don't know what an acceptable, day sales outstanding would be for my industry or segment without doing more research. The data always changes. So I will tell you every month, if you start crunching these numbers, your targets move. That day sales outstanding is different in January, February, March, April, May, June, because it's depending on your customers and the efforts you're making on collecting from the customers. And then it's also relying on the quality of those financial statements. So how good are you at entering that data into QuickBooks? Are you posting sales in the right amount of time? Do sales sit on the desk for a week before they get entered into the accounting system? If that's the case, probably those metrics aren't going to line up too well with what you're actually doing. So those are some of the pros and cons of using metrics to gauge your working capital, or using metrics to determine how well you are in managing your working capital. So then going to the other side, we have examples of working capital management best practices. So this was my favorite part. Now, being in treasury management, my little bio at the end, I make a joke. Treasury management is a great fit for me because I love numbers. I am Greg worked for me in the past in a different life. I am a spreadsheet king, so I try to track everything I can. I track trends. I do all the fantasy football stuff, and I'm not interested in watching the games as much as I am the statistics. That's how sad it is. I do like metrics. But as I said, they're not always telling the whole story. The best practices are really where you dive into what you're doing. How do you do it? How can you can get better, right? So, for example, a couple examples we have in here. When we talk about best practices about metrics and management reporting, do you have working capital targets that you manage to? Do you want to be at 30 days? Do you even care how fast you collect from your customers? Most companies that I interacted with, they really didn't have targets. They didn't manage the targets. They didn't say, you know what, we're at 40 days this year. We want to get to 35 days next year. Because we know if we're collecting faster from our customers, we don't have to borrow as much money. We can put our money at work for us more than sitting on our customers and our customers' bank accounts. Do you track these metrics? Are they part of your management reviews? Do you talk to your accounting, to your COIs? I always think small businesses especially have a circle of trust. It should include, the key principals in your business. It should include your law representation, your lawyers, your accountants, and your bankers. Those are the folks you lean on, especially in small business, because you don't have the resources. You don't have a staff. You don't have a finance staff of 20 people like a Goodyear, or 50 or 100 people managing all your finances for you. So tracking to these yourselves and paying attention, there's some benefits. Benchmarking information, I mentioned that a couple minutes ago. Finding a way to benchmark. So where is those other asphalt companies we referenced to earlier? Are they at 10 days sales past due in February? Are they at 45 days in May? Are we worse than our competitors? Are we better than our competitors? If you're better than your competitors, that's something to sell to the bank. It's something to sell if you're ever looking at moving your business. That's a feather in the hat. That's a good thing. So we talk about receivable terms. These are some good ones I would get companies on when we talk about these. So the second one in particular, standard collection terms are equal to or less than standard payment terms. That's just a fancy way of asking whether you collect in line with your terms. I can't tell you how many companies say net 30 on their invoices. So, we give our customers 30 days to pay, right? Well, what happens when they don't pay in 30 days? Most companies say, well, we give them to about 45, 50 days, and then we have Carol give them a call, or we shoot them an email. Or we know our customers, and we know the ones that pay at 60, we know the ones that pay at 30. A couple pay at 25, so that's good. Well, let me tell you, if you don't collect from your customers to 45, 50, 60 days, your terms might as well be 45, 50, 60 days. Because just like, think of your mortgage payment, if the bank didn't care if you paid it on March 1st and let you pay it on March 30th without a penalty, most of us would probably rather pay it on March 30th because we could keep the money for an extra 30 days. So essentially, you're funding your customers when you allow them to extend terms. And the word collection can mean a lot of different things. So my first job in banking was a collector, a lot of fun. It's like I was so afraid of that job. To this day, I still don't want to make a collection call. And I did it. I was a manager and a part of that group for probably 4 years. And it still scares me on a Saturday morning if I had to make a collection call. I hate waking people up. But that's the far end of collections. You can collect by sending an extra invoice, just letting your customers know, like at 30 days, hey, we send, just to let you know, if you don't pay in 30, we automatically have an invoice go out via email, just as a reminder, right? Now it's not even a special event, and that reminder will prompt your customer to pay faster because we're people. We need reminders. There are people running those businesses. Think about owing your friend, you ever owe a friend money. Let's say you owe two friends money. Both of them you owe $50 to. My guess is you're paying the friend that's going to ask you for it first. And the other guy that doesn't really care, you're going to pay them second. It works the same way in business because we're people and people manage businesses. Another good one is discounts. So discounts have been something, you discount your customers for paying fast. So, maybe it's 210 net 30. So if your customer pays you within 10 days of the invoice, you're going to discount them 2%. Do you need that money in 10 days? Maybe you're a cash-rich company. Maybe you're sitting on $1 million. You don't need to borrow. You've just done a really good job of building up your reserves so you don't have to borrow. Well, there's no reason then to offer a discount for quick pay. There's no benefit to you. There's a benefit to your customer, but you could just extend those terms to 30 and keep that 2% as profit, or improve your margins. And then in treasury management, a near and dear one to us is effective fraud and risk controls. So having things, if you haven't heard about positive pay, if you're not using something called positive pay, you are in a very significant risk in your bank accounts of people stealing out of them. Whether it's fraudulent check, a fraudulent electronic transaction. It is much easier than you believe to steal out of your business bank account. It is much harder for a bank to catch them, and there is much less liability on the bank than you think. Those are just realities of today. So whether you bank with Huntington, whether you bank with anybody, if you only take one thing away from this, please talk to your COIs, talk to your accountant, talk about the word positive pay, learn about it, make it your best friend. It can protect your capital, it can protect your business, it can save you a ton of trouble. It's not a fraud presentation. It can easily turn into one because it's probably the worst call we ever get is, I got a couple checks here and they're not mine. It's a very real call. It happens weekly. across our business here in Northeast Ohio, and it's, like I said, the least favorite thing that we deal with. So what are the processes that you manage in working capital? What do you have to do, right? So this is sort of the circle. This is what every company does, maybe in a little different way. You know, if you're a law firm, you don't usually put people on terms. Typically, you're due, you know, services are complete, you're due, maybe you have a billing plan. But if you're a manufacturer specifically, you're going to have customer credit and payment terms. You're going to establish people on net 30 days. You have payment terms. What type of payments do you accept? That impacts your working capital. If you only accept checks, you're taking payments the slow route. That's snail mail. The U.S. Postal Service, my dad's retired from it. I can make fun of it. All right, it's not as good as it used to be, and it's probably not going to get a lot better. So mail is not as reliable as it used to be. It's taking a little bit longer for mail to get places, especially local delivery. If you have inventory, how do you manage it? You know, do you look at your inventory? How fast you turn it over? Is that an efficiency metric that your maybe inventory manager uses? And then you have your supplier credit and payment terms. Whether they're suppliers on credit, whether they're vendors, whether it's your payroll, whether it's, you know, paying for the trash being taken out, those are all accounts payable type events. So things like maybe using a credit card to put that trash payment on, extend your cash flow on that bill for another 30 days. You don't have to pay the card off. It's interest free. Maybe that money's invested in a money market, and as interest rates go up, right, you make a little bit more money on that. So this is in treasury management sort of our key to consulting with every one of our companies. This is the process we're looking at. This is the process we're trying to help you improve. Sometimes it's with bank products. Sometimes things like Positive Pay and those scanners that like you not go to the bank. Sometimes it's with that. Sometimes it's just with sending another invoice to remind a customer to pay faster. So there's a combination of things the bank can help you do, but also there's a lot more things that you can help yourself do to get better in working capital management. So utilizing best practices. Once again, there's good things and bad things. And after we go through this, just to let you know, I do have an example that we'll quickly run through of somebody, it's sort of a fictional company. It isn't, but just to walk you through how we look at these and what this ultimately bubbles into. But one of the best things about working capital best practices is that it promotes continuous improvement. I've gauged my entire life based on continuous improvement. I can always do something better. You know, I could do this presentation 1,000 times, and on the 1,001st time, I want to do it better. That's just what drives me. And small business owners, I know that entrepreneurial spirit, you want to get better, you want to have a great business, so that's all sort of in your DNA. Best practices help you do that. A lot of these best practices reduce risk, reduce cost, enhance visibility into your operations. There's a lot of good about them. There's not many bad things in best practices, okay? Focused on your efficiency and the maximization of resources. Your time, your expenses, that's the sort of things they're focused on. Now, the not so good of working capital best practices. They don't all provide value. So an easy one to use, I don't know how many of you are familiar with what a lockbox is, but a lockbox is something that, you know, not just banks, but somebody would offer where you have your mail shipped to me, we'll open it up and process it for you, and we'll just deposit the money and tell you who paid you, okay? It's a great best practice, but when you only have 10, 100, 200 payments, it's a very expensive best practice, so it may not be in your best interest to use a lockbox. So not all best practices provide value. They're also in the eye of the beholder. Some people love the control aspect of getting funds, going back to that lockbox example. I like the customer sending money to our office. I like using our address. I like opening those envelopes. It's a tangible feel to me. So that lockbox, the value isn't there. So that's the eye of the beholder. You have to determine the value on your own. We can tell you all the great things about it, but unless you believe it adds value, it doesn't matter. It doesn't matter what we think. Some best practices increase cost. Like I said, the lockbox. You know, are you going to spend $300, $400 to process 100 checks? Maybe, maybe not. Depends on your individual scenario. Now, will you pay, you know, maybe $500, $600 to manage 1,000 checks? That's a different story. You know, how much mail can your office handle? Who's touching the mail? How much risk is involved with that? Some of the things to think about. Best practice data can be difficult to find. You know, we consulted with an outside firm to come up with like 58 best practices. if we didn't have that, it's sort of us making them up our own. So trying to find those best practices is not always the easiest thing either. So those are some of the pros and cons of working capital management, using best practices to gauge your efficiency. So any questions before I go into the example? We doing all right on?
Thank you. I just got my Experian, my free yearly Experian, right? So I have an LLC, and it's my joint stock. But it's amusing to look at all these accounts that you forget you have sometimes. But one thing, it said, closed at client's request, but still will stay on record till 2022. So if I go to a bank and I'm, you're looking at getting some capital, and you're looking at that kind of credit score, credit score, but you're looking at something like that. Is that going against you, even though that's closed? But why would it be on there until 2022?
A little bit. It's part of it, okay, but it's only a piece of the puzzle. I would say, if it's a one-off instance or something like that, I wouldn't get too hung up on those things. Sometimes the business banking credit report is mainly telling us how you are utilizing other vendors, whatever terms they might have. You guys might not always agree on something, and that doesn't show up on the credit report, but there's a story behind that. I've had it where there's been a deal gone wrong, somebody didn't fulfill their terms, and the guy refused to payment. So it looks like he refused payment and he defaulted, when in fact it was an ongoing dispute as to who's going to fulfill those. So I would not get worried about that. And we can go a little bit after this. We can do a little bit more question and answer about, some of those things that the banks look at in order to, if you're looking, for bankability, what we look for lending requirements and stuff like that. We can go into that a little bit after this, but I wouldn't sweat that as much. It's a really small piece of the puzzle, but it is something that banks tend to look at.
Not as a negative per se, especially closed at customer's request. It's that mystery of the personal credit bureau. Good luck figuring it out, right? I mean, even as bankers, there is no guide that says, here's how a credit score is ultimately, somewhere out there it is. But to Greg's point, when you interact with relationship managers, when you get away from just the clear processing to a number, right? You fill out an application, you click submit, and you get an answer back. When you start talking to people, there's much more diving into those things and having discussions to clear them up manually than it is just looking at a report and say, oh wow, a lot of closed accounts, we don't like this guy. That's not the process we go through. So
you're going to tell us about Prestige Worldwide?
Prestige Worldwide, yes. So the name is fictional. The numbers are related to an actual company, okay? So for this case point, Prestige Worldwide, a local screen printing company. They've had some rapid growth. They went from $5 million in sales to $20 million over the last 5 years. Rapid growth is a great blessing and curse all at the same time, okay? So as this company's grown, they've modestly expanded their finance staff. They've added an additional AR clerk. They've added an additional accounts payable clerk to help manage the extra inflow of receivables and payables. The process, though, themselves have remained pretty much unchanged for 5 years. So this is very typical what we run into. You build a process, you're used to doing it, you start to grow, you just incorporate that new business into your existing process, all right, until the point where it doesn't work anymore and you have to change it. For this company, they operate on cash, typically, but we've noticed over the last 6 to 12 months the frequency of borrowings has increased, rather rapidly, actually. So there's a little bit of concern of, this is typically a cash-rich. I like to use the word cash-rich when you don't have to borrow. It's just an easy term to differentiate between net borrowers and those that don't have to borrow. So we have a cash-rich company that for the 5 to 7 years they banked with us has not really had to use their line of credit. Over the last 6 to 12 months, they're using it rather extensively. So a little bit cause for concern for both us and the company because they're incurring interest expense that they'd rather avoid. So what can we do about it? Let's take a look and see what's going on and try to find some ways to address it. So we talked about those working capital metrics. So here they are. It's probably going to put it a little bit better terms to actually see them on paper. At least that's how I'm an example type person. I like using examples. So days sales outstanding, just walking you through this a little bit. I use the dots, but it's sort of we're starting at the top and working our way down. So Prestige is collecting their receivables in 10 days, all right, which is awesome. 10.27 days. The benchmarking data, comparing them to other screen printers, the upper tier of that benchmarking data is 17 days, so Prestige is collecting faster than their competitors, significantly faster than even the best benchmarking results that are out there. You see where the average benchmarking data is, and then that lower end, so what's the longer end of that receivables process. So they're beating it by 26 days. Their inventory, they're beaten by 25 days. Their payables, they're actually 14 days higher. That's a tricky one. So from a bank, we might think that's great. We might not think it's great. So if you're in good terms with your suppliers and you're able to extend beyond 30 days and hold on to your cash for 45, that's not a bad thing. At the other end, if it's because you don't have the money to pay them, that's a different story. So days payables outstanding is one of the ones where you can be above the benchmark, below the benchmark, depending on your unique business situation, and it could be good and it could be bad. Days sales outstanding, typically when you're beating the benchmark, that's a good thing, right? You want to collect money as fast as you can always. And inventory, you always want to turn inventory as fast as you can. So those are ones you always would like to be below the benchmark. Payables, depending on your specific strategy, customer base, and industry, you may be above, you may be below. So the cash conversion cycle. So that ties all three of these together. All that is you take days sales outstanding plus days inventory outstanding, subtract days payables outstanding, think of it as a circle, and you're turning your cash in this company is actually turning their cash negative 27 days. Negative working capital is a beautiful thing, at least it should be. That means I'm collecting money from my customers before I have to pay my suppliers. You can finance your own operations. It's wonderful when that's truly how it's working. Now, if we take Prestige and compare them to a competitor outside of benchmarking, okay, so this is another screen printing company. They compare even more favorably. This competitor is at a 40 days sales outstanding. They don't turn their inventory as fast. Their days payables outstanding. They pay their bills quicker. That could be a good sign, like we said. It may not be. That cash conversion cycle is significantly longer. It takes this other screen printing company a lot longer to churn through their cash and get it replenished than Prestige does. So, so the metrics look extremely well. Like Prestige is killing it, right? They're in a negative cash conversion cycle. Their customers are financing their business. There isn't a better scenario. However, this is where the metric part does not add up to the best practices. If they were, in fact, turning cash that quickly, they shouldn't need to borrow as much. But here, in turn, they are still borrowing, and that borrowing is increasing. If we look at this trend analysis, so this is where this is one of my favorite parts, is looking at things over time, right? Statistic analysis. So if you look at Prestige over the last 3 years, you see there's been a 65% reduction in days sales outstanding. Something has happened to take receivables from 29 days to 10. And that's something we want to dive into, right? Their days payables outstanding has remained completely unchanged. Once again, could be good or bad, depends on the specific business and the conversations we have. Inventory has been cut in half, the time that they hold on to inventory. That's probably a good sign. That's usually a sign of improving supplier efficiency. Like for this specific company, they actually have a supplier that is so close that they can almost do just in time. So unlike a lot of screen printing companies that, they may not be supplied by someone down the street, they have to order in advance. This company is able to order as little as a week in advance to get the inventory they need to do their screen printing. And then there's been a 939% decrease to the cash conversion cycle. That's mostly because of collecting sales a lot faster, all right? So once again, these trends are extremely positive. We're wondering, why is this company having trouble managing their working capital? Why are they needing to borrow more? The metrics aren't going to tell us the story. That's why we got to dive into the best practices as well and line the two up together. So in this case, we talked about strong working capital metrics. They've improved over 3 years. It's awesome. They should be in a strong cash position. We've mentioned that a couple times. So what's the negative? Well, the day sales outstanding, all they did is start taking credit cards. So not a huge change in process. They just started accepting credit cards, put it online, making it a lot easier for their customers to pay. Boom, all of a sudden the majority of their sales are starting to be made by credit cards. Now there's a cost to them in that, right? They got to pay the margin, but they're collecting so fast that they're willing to live with that margin. Maybe they bake it into their overall cost as it is anyway. Because I know if anything small business owners love, it's interchange fees to merchant providers. You love paying for people to pay you with Visa and MasterCard. I'm being sarcastic, obviously. Just like bank fees, aren't they so much fun? My son has told me he does not want to be a banker. He sees it, he's like, I don't know, my friends say they don't like paying the bank for fees, and you told me that's a lot what you do. I said, but my fees help them.
My son's banking fees are.
No, he just hears me talk about work too much. All right, and then even though their days sales outstanding has improved, they've wanted to get their days payable down to 30 days. It's sort of been a goal. They want to pay their suppliers faster. They want to improve their reputation. They haven't been able to. They have very little availability of their line of credit, and their competitor is in a much better working capital situation, the one we showed you at that 40 days sales outstanding, than they are. So those metrics, while they look really good, they're not telling us the whole story. In fact, they're sort of misleading the story. That's why you just can't rely on the numbers alone. So let's take a look at their best practice review. This is just a piece of it. So this is on the receivables portion, okay? So when we would go about doing these with companies, we'd have this 58-piece questionnaire, and it would touch on a lot of different aspects of their business. So in this case, we're just taking a piece of it. It's receivables. So we look at, out of the best practices, how many are they utilizing in their company? Well, standardized terms, 25%, not a whole lot. Timely and accurately invoicing, 11%. They don't use email invoices. They mail everything out, okay, which slows things down. It's harder to re-invoice somebody and more costly to use the mail. Process automation. They do a lot of things manually. They don't do a lot through automation. Their collection process is clunky. It's very inconsistent. When somebody's past due, they may not call to 75 days, even though their terms are 30. And I also should say part of this screen printing company is consumer as well, and consumers don't get the terms that the business side of their business does. So consumers tend to get due on receipt. They're comprehensive in information and reporting. They get the information they need. Now, whether they're using it or not is a different story. But if you look at, they're only doing about 30% of best practices as it relates to collecting receivables. A lot of room for improvement. Some business owners love hearing this. Some business owners don't like hearing this. But it's the reality of the situation. And then it's our job or your job to determine, hey, what best practices, maybe you can never score 100% because the value isn't there in using all the best practices. But you can get better. We know you can get better. Everyone can get better. Even we've never had a company score 100%. So what's the good side of using best practices? Process and procedure review. Sort of painful. We don't like doing it in our personal lives. We probably like it less in a business. Sitting down and having a meeting to go over what we do today and how we should be doing it differently. Pulling in the office manager, pulling in your AP and your AR clerks. What's working, what's not? Do you do that on a regular basis? You should. They can identify opportunity for greater efficiency, managing your working capital cycle. So, using best practices, do you consolidate your balances? Do you operate out of multiple accounts? Do you spend all your time transferring money back and forth? Would there be a benefit in automating it? Can you consolidate those into just one bank account instead of 4? That's what best practices help you talk about. And then find out where you're good. Where are areas that you're successful at? There are companies that are awesome at receivables and then drop the ball on payables. So, it's great. We always love hearing what we do really good. So what is it that you do really good in receivables that we can carry over and apply in payables to help improve the efficiency, help improve the relationships with your vendors and so on? What's not good about best practices? We talked about that value of change, putting that lockbox in. Is it really going to help? Is it just going to add cost to it? Sometimes the value is difficult to determine. If we start invoicing people at 30 days, when they're 30 days past due, are we going to get a pickup from that? You won't know until you try. So sometimes you may not want to try unless you know. Some best practices are more relevant than others. And then the time it takes to do this. You're busy running your business. You got kids. You got to get them to school. You got networking groups you have to attend. We don't have time to go over this every week, every month, every quarter. So that's a negative to trying to go over best practices because of the time it takes to do this. Bringing it all together, the point of the presentation, the point of it is utilizing your metrics, utilizing best practices, and bringing them together to determine how you can improve your working capital management. You know, maybe it's calling a customer faster. Maybe it's using email. Maybe it's asking for electronic receivables. You know, we talk about ACH. Okay, so ACH is something you don't need to buy from a bank. Companies can send you ACHs that you do business with. A lot of, we run into a lot of companies, we're just comfortable with checks. We like people sending us checks. Have you asked them to send you electronic payments? No, we haven't. Why? You always want electronic payments. They're faster. There's no risk in the mail. They clear quicker. It's like your direct deposit of your paycheck. Everybody loves that, right? I would never want to go back to getting a paycheck. I've worked for banking 16 years. I've had 2 paper paychecks in 16 years. Such a pain. I could actually go to the bank. Now I guess I could take a picture of it. But it's not available right away. Whereas on Friday night at midnight, or Friday morning, 12 a.m., my paycheck's there. I have it first thing Friday. I don't have to wait in the line to get it from the payroll department. I don't have to wait for it to get mailed to my house. I don't have to go to the bank on a Friday afternoon to deposit it. So those are just some of the things that go into this sort of review to think about, like electronic receivables. Bringing them together results in improvement, and that's ultimately where you want to be. And that's it.
And we'll open up for questions now, but I really find a lot of value having this conversation with our businesses. And what I try and I preach to my customers is having this kind of conversation, having this kind of analysis done, proactively. Many times I see my clients come through times where money gets tight, working capital gets tight. It gets to a point where they might be struggling to find a working capital solution from a bank as far as an influx in capital. Then you come back and you start looking internally where you can improve, and that's retroactive. That's not as helpful as how you can get this done, how you can get some perspective on how you're doing things, and create those benchmarks for yourself to get more improvement out of your own current working capital. Because these are all things that, as a lending institution, will be viewed and analyzed as well. To gauge how well you're going to be able to pay back any kind of debt service you might take on. So, thank you, Tom, for coming in and standing in for me and giving the working capital presentation. Now, we'll open up for questions. I think we have a couple minutes for questions. So, anybody have anything they want to ask about either the presentation or anything in banking in general that we can give some? Brenda, do you want to? Oh, you passed off your responsibilities?
Just a question regarding when a customer comes to you and says, I'd like a loan for whatever the dollar number is. Aside from working capital, what else should a business owner be looking at or be mindful of when they're running their business on a daily basis, that if I'm ever going to need a loan, what is the bank going to be looking for from me?
I can go over a litany of different things that we look at, but I would say above all, what I look for is I'm looking for cash flow. Cash flow is king. I'm going to look at the bottom line. I'll do an analysis of all your financials, how you're using your money, where your costs are. But bottom line, we got to see that you guys are making a profit. You're getting paid as a business owner. We like to see that you're bringing value. There's equity in the company, and then cash flow is really going to determine what kind of debt service we can do for you. So the more profitable you are making yourself, the more availability we would have in order to lend to you for whatever the facility might be. Now, it's a little bit different for working lines of credit as far as where you have to be with that, as opposed to the commercial building you're running your business out of. Oops.
I'd add to that and say, are you getting credit when you don't really need it, or now are you at a point that you need it and it's almost too late, right? So the best time to get a line of credit or to get credit established is when you really don't need it. Things are going really well, and you have it there in case things don't go so well, because then you get into it's almost too late, right? Cash flow's failing, profitability's taking a hit. I think we need to go to the bank and get a loan. And you're starting to get into a position where now you have that concern. Of course, the bank's going to have it as well, and it becomes a lot more difficult. So, but I think Greg handles more on the lending side, and I'm more on the inner workings of getting the monies in and out of the account. on the treasury management side. So.
And it all kind of works together. I mean, that's all part of the cash flow cycle, and we do look at that all. But yeah, 5 C's of credit still run true. You know, it's your character, it's your cash flow, it's all of those things that we're going to look at. Any other questions?
Actually, mine was a lot along the lines of Chris's. Hypothetical, I'm in insurance commercial, and are we going to be obsolete in 10 years? Bank tellers, like you just said, I don't need to stay in line at the bank. Guys are buying insurance. The new generation doing so much online. There's always going to be a need for people like us, for people that have more in-depth type of situations, but I can see at a time when there's not going to be need for bank tellers to drive up and deposit. And same with insurance guys for buying an auto policy. It's happening already. So just your thoughts on that in general.
Well, I think of it like a library. We're always going to have libraries. I think we'll always have a library, no matter how much they put online. There's something about that site. There's something about that tangible. So I think in the early 2000s was the first, like, we don't need banks anymore. We just have ATMs everywhere. It doesn't work. People need people. People have questions. Accounts don't work the way they're supposed to. I don't think we're going to be obsolete as fast as we think. I think, yeah, sure, maybe eventually. But Huntington, for example, like, has doubled down on branches. I mean, we have the most branches of any bank in Ohio. And we continue to grow that because that's what customers want. People want the face-to-face. They want that interaction. And it's not just at Huntington. I think at other banks as well. I do see a trend, like, for example, we have these sort of newer, you see the Giant Eagle branches, right? They're smaller, a little more efficient. I could see that. I could see smaller branches with more efficiency models put into place, maybe less people in those branches at the end of the day, but they're still going to have the branches, they're going to have the tellers, because just not all of us, we all change in time. And I mean, you even have millennials that don't necessarily trust the banking system, don't want to take pictures with their phone, and they may never be comfortable with that, So I think it determines how much fees and cost of salary and all that, and ultimately, right, money drives everything. So as long as it's still a cost-efficient model to have branches, the banks want to do that because, one of the reasons I stay at Huntington is the relationship thing. I mean, it's people, it's business banking, small business owners, it's our customers we get to see periodically, and hear about their lives and their stories, and you get to see their businesses grow. That's what makes it fun. And I, as much as the corporate Kool-Aid comes flowing down, I still believe in it. I do believe that we, especially, like Huntington, not to do a commercial, but we're the largest small business lender in the state of Ohio. In fact, we're like second in the country or fourth in the nation, and we're like in the 20s in bank size. So I mean, we love small business at Huntington. So it's a really good fit for the things that are important to us to get to go out and do things like this, and spend time with small businesses. And other banks realize the value of that too. I mean, large corporates, yeah, they make a lot of money, they pay a lot of fees, but it's impersonal. It's not the personal touch of the small business in the consumer world. So. Maybe I have some questions. Does anybody use the metrics of day sales, payables? I mean, any manufacturers, anybody that is in that room that crunches or looks at those numbers? Because even there's ways to look at it. You don't have to necessarily have dedicated AP. You can look at your vendor payments. You can look at expenses. We were very successful in doing some of these analyses with companies like an insurance company, like a law firm. There weren't necessarily, maybe it was a little bit of a stretch to get the metrics, but we still went through how you collect from your customers, how you invoice your customers, just going over those processes. I can't stress how important that is and how much value we business owners saw when we actually sat down to talk about it, because we do get so caught up in doing what we do every day. It's almost like that life reflection moment. I don't wake up every morning and think about everything I do, but every once in a while we do as individuals, like, boy, why do I drive that extra 2 miles every day? Is it really the smartest thing I should do? And thinking about it in that business aspect, I think of when I got into treasury management, the check scanners were a big deal, but they were so expensive. And it's like, well, I'm not spending $1,500 for a box that deposits checks when it's on my way home. Well, now, okay, $1,500, I get it. Well, now if you're talking $30 and you're on your way home, what's it worth to you? Because you're the most important expensive resource to your business when you're an owner in management. The time you spend out of your business to deposit checks and things like that is essentially can hurt your business, because you'd be better served. You're more valuable managing the aspects of that business than going to the bank. You just are. So looking at things like that and what's your value proposition in your time, and forget about not just bank fees, service fees, any fee, whether it's to a bank, whether it's to a software provider, you know, what is the value to you intangibly to be able to automate something? You know, we all hear the word automation and we, oh my gosh, automation, I don't like that. I'm not talking about, you know, replacing people with machines. We're talking about automating processes to free up your people to do better things. We have companies that have so little time to focus on collections because they're so busy printing and putting invoices in envelopes and mailing them out. What happens when you turn that to just a click of a button and email everybody? And if you make an effort, you can get more people than you think on email. But you have to make that effort. You have to ask your customers, and not everybody wants to do that. You know, not everybody loves hearing the bank tell them to do that either. But it is something you want to hear and think about. And how can we do that? Maybe we can't invoice everybody electronically, but maybe we can put half of our customer base on electronic invoices, and all of a sudden we're saving $100 a month in stamps. Maybe it's $100, but trust me, you know, sitting on the bank side, we've heard people say no to fees for $20 a month. They don't want to spend $20 a month on something. Well, what if you find that money is elsewhere and redeploy it in your business in a better way? I mean, that's really how you win. Not adding expenses, but finding ways to better manage your expenses or making your expenses more valuable to the bottom line. So.
Well, if there isn't anything else, thank you for having us here. We really appreciate it. If you have any questions that come up otherwise, our information's in there in the folders. Please feel free to give us a call. Thank you.
Thank you.